Okay, so let's look at the calendar. It is January 18th, 2026.
Mm-hmm.
The holiday decorations are, hopefully packed away.
Hopefully.
And for a lot of people, that means one thing is starting to creep in. That that sense of dread.
Oh, yeah. Tax season, the time of year everyone loves to hate.
But this year feels different. The dread might actually be misplaced.
It might be.
We were looking at a stack of documents today, legislative text and great analysis from Nexus tax books, Treasury updates, and it all points to a really unique filing season.
It's all because of the one big, beautiful bill.
I still cannot believe that's the actual name.
The OBBB, right. Signed back in July of 2025. It sounds like a joke, like pure political branding.
But it's not.
No. When you strip away that terrible name, the machinery underneath is, well, it's fascinating.
And it's lucrative. That's the real hook here, isn't it? This isn't jargon.
This is cash.
Looking at the breakdown, we're not talking about, finding 20 bucks in an old coat pocket.
No, we're talking about sums that could seriously change a family's financial year. So the mission of this deep dive is really to decode how that happens.
Okay.
Because the bill does two huge things at once. First, it takes some of those temporary tax cuts from the old TCJA days and locks them in, makes them permanent.
Which is a big deal in itself.
Huge. But then it layers on these brand new temporary deductions that are designed for the return you're about to file right now.
The headline number that jumped out at me from the analysis is that these changes could boost refunds by an average of $1,000.
$1,000.
That feels high for an average.
It is high, but that's the why now for everyone listening. These changes apply to the return you're filing as we speak. This isn't some future thing to plan for.
And there's a catch.
There's always a catch.
Yeah.
A lot of this money is not automatic. It's hidden behind a new form called Schedule 1A.
Schedule 1A. Okay, that sounds like the kind of boring administrative detail I usually just gloss over.
And if you gloss over it this year, you are literally leaving money on the table. The IRS is not going to flag it for you. If you don't ask for this money, they just keep it.
Okay, that puts the stakes in perspective. So let's unpack this. The biggest buzz we've seen online, on social media, is all about hourly workers.
Mm-hmm.
I keep seeing these headlines screaming, no tax on tips or overtime. Is that hype or is it real?
It's a dangerous mix of both.
Oh.
We have to clarify the language right away. That headline makes it sound like an exemption.
Meaning the tax just vanishes from your paycheck.
Right, and that is not what's happening. It's a deduction.
Okay, so break that down. Practically speaking, for the person listening who just worked a double shift, what is the difference?
It's a huge difference. An exemption means it's never counted as income. A deduction means it shows up on your W-2, but then you get to subtract it from your taxable income when you file.
So it lowers the amount of money the government can tax.
Exactly. But, and I can't stress this enough, you have to actively claim it.
You have to ask for it.
If you just file a standard return without filling out Schedule 1A to back out that money, the IRS will happily tax it just like regular wages.
So passivity is expensive this year.
Got it.
Let's look at the tips bucket first. Who actually qualifies?
It's broader than you'd think. It's not just the traditional waiter and bartender stereotype.
Okay.
The IRS list is pretty specific. Yes, hospitality is the core, but it also includes musicians, tutors, estheticians, salon workers.
Wait, musicians and tutors. So if I'm teaching piano on the side or playing a gig at a coffee shop, the cash in the tip jar counts.
As long as it's a customary tipping role, yes.
Yeah.
Cash, electronic payments, all of it. But there's a massive trapdoor here that I think is going to catch millions of people.
What's that?
Service charges do not qualify.
Oh, that is tricky. I see that everywhere now. You go to a restaurant, group of 6, and they slap an automatic 20% service charge on the bill.
Exactly. And under these new rules, that's classified as regular wages. It's not a tip. So if you're a server living off those automatic gratuities, you can't deduct that part.
It has to be a voluntary tip.
It has to be voluntary. And the mechanism for claiming the real tips is strict. You have to have reported those tips to your employer by the 10th of the following month.
So my January tips had to be reported by February 10th.
Precisely. Your employer puts them in box 1 of your W-2, so it looks just like income. But then you take that number and you use Schedule 1A to deduct it. That's the trick.
And this is for a few years, right?
It is. This runs from tax years 2025 all the way through 2028.
A 4-year window. Okay, let's pivot to the other half of this, overtime. This feels huge for, blue-collar workers, delivery drivers, anyone grinding out extra hours.
It's a major win, but again, the definition matters. It's all based on the Fair Labor Standards Act, the FLSA.
Which defines it how?
strictly as wages for hours worked over 40 in a single week.
And there's a limit, I assume. I can't just work 100 hours a week and pay zero tax.
Right, there are caps. You can deduct up to $12,500 of overtime pay if you're single. And if you're married filing jointly, that cap doubles to $25,000.
That is still a really significant chunk of money.
It is. I mean, think about someone in the 22% tax bracket. Maximizing that deduction saves them over $2,700 in actual cash.
That's a few car payments.
For sure. But here's where it gets really frustrating. The sources call it an administrative hurdle.
That's the problem.
It's a data problem. There's no separate box on a standard W-2 that says overtime pay. It's all just lumped into wages in box 1.
So how does the IRS know what portion was overtime?
They don't. The onus is entirely on you, the worker. You have to track your own hours. You have to calculate how much of that box 1 total came from overtime.
Wow, so if I didn't keep my pay stubs from last March, I might be out of luck.
You might be in trouble, yeah. I mean, employers might provide an estimate if you ask, but they aren't legally required to break it out on the W-2 itself.
So you need your pay stubs.
You need your pay stubs, you sum up the overtime earnings manually, and you enter that number on Schedule 1A. It's a huge shift in responsibility.
No kidding. It used to be, you get a W-2, you punch in the numbers, you're done. Now you have to be your own bookkeeper.
That's the theme of this whole bill, active participation. You have to ask for the money, and you have to prove you deserve it.
Okay, well, let's talk about a group that might have a slightly easier time. The silver tsunami. Seniors over 65 are apparently the big winners here.
They really are. The structure of the OBBB seems designed specifically to give them relief, and it works through what I call the stacking effect.
Stacking, I like it. Walk us through the layers.
Okay, so picture it like a layer cake of deductions. Layer 1 is just your base standard deduction. For 2025, that's inflation adjusted to $16,100 for singles.
And $32,200 for joint filers.
Right, that's the rice line. Now, layer 2 is the age adjustment. This has been around. If you're 65 or older, you add another $2,050 if you're single.
Okay, so we're inching up. Then comes the OBBB special.
Layer 3. This is the new one. It's a temporary bonus deduction of $6,000 per qualifying individual.
Whoa, just a flat $6,000, no receipts, no nothing.
A flat $6,000. If you're married and both over 65, that's $12,000 right there just from this bonus.
So, okay, let's run the numbers for a single senior. I'm doing the math. 16, one base, plus $2,050 for age, plus the $6,000 bonus.
That's
$24,150.
$24,000.
Exactly. Just removed from taxable income completely. For a lot of retirees, that means their entire Social Security check and a big chunk of their pension could be tax-free.
That is massive. But there has to be a gotcha. Does the billionaire retiree get this $6,000 bonus?
No. The yachts are excluded. There are income limits. This bonus starts to phase out in $75,000 of modified adjusted gross income for singles.
And double that for couples.
$150,000 for couples. Yeah. So this is really targeted at low to moderate income retirees.
Not the wealthy.
It's a lifeline, not a luxury.
Right.
And just like the tip rule, this is temporary. It runs from 2025 through 2028.
It's a very targeted. It's surgical. It really is. It picks winners and losers based on demographics and employment.
Speaking of demographics, let's move to another group that was really sweating 2026. Families. We were looking at a potential fiscal cliff.
That was the big narrative last year, yeah. Families were terrified. The child tax credit, the CTC, would revert back to the old, lower level.
But it didn't.
No. The big headline here is relief. The OBBB made the CTC expansion permanent.
Okay, so what are the numbers now?
It's set at $2,200 per qualifying child. But the most important part, the part that actually helps people pay rent, is the refundability. $1,700 of that is refundable.
Remind us again why refundable is the magic word here.
Think of it like store credit versus cash back. A non-refundable credit is store credit. If you owe $500 in tax and have a $1,000 credit, you pay $0, but you lose the other $500.
It just disappears.
Right. A refundable credit means the government sends you a check for that $500 difference. Even if you owe $0 tax, you get that cash in your bank account.
That's huge for lower-income families.
It's basically a negative income tax. And the sources also point out another subtle but critical change.
What's that?
Inflation adjustments. The OBBB added them to the CTC. So that $2,200 number will actually grow over time so it doesn't lose its value.
That's smart policy. And the Earned Income Tax Credit, the EITC, got a similar boost.
It did. also adjusted for inflation. For this year, the max value for a family with 3 or more kids is up to $8,231.
Over $8,000.
You combine that with the child tax credit, and for a lot of moderate income families, filing taxes isn't about paying, it's about getting a significant payout from the government.
It's being used as a social safety net, plain and simple.
It is.
Okay, we've covered workers, seniors, and families. Let's talk about small business owners, especially those in high-tax states.
Right. New York, California, New Jersey.
They might want to sit down for this part.
We're talking about the source of deduction, state and local tax.
This has been a political football for years.
A very hot football. Under the old rules, you could only deduct $10,000 of your state and local taxes from your federal return.
Which, if you own a home in the suburbs of Chicago, barely covers your property tax.
It's nothing. You were paying federal tax on money you'd already paid to the state. It was double taxation.
So what's the new number?
They raised it significantly. The new cap is $40,400.
From $10,000 to over $40,000.
It's a quadrupling, yes. And it's $20,200 if you're married filing separately. But for most, that $40,000 cap is a game changer.
And this has a huge impact for pass-through businesses, right? Sole proprietors, LLCs.
A huge impact. Those owners pay business taxes on their personal returns, so being able to deduct $40,000 of state taxes against that income, it drastically lowers their federal bill.
Is there an income limit on this one too?
There is. This benefit starts to disappear if your MGI goes over $500 to $5,000. So again, it's targeted more toward the upper middle class, not the super wealthy.
And there was one more acronym for business owners. QBI.
Yes, the Qualified Business Income Deduction. That's the one that lets you deduct up to 20% of your business income.
Which was set to expire.
Causing a lot of sleepless nights, yeah. The OBBB made it permanent.
So if you make $100,000 from your business, you only get taxed on $80,000 essentially.
Essentially, yes. And knowing that's permanent, that gives businesses stability. They can plan for the long term.
So if you combine these, higher SALT cap, permanent QBI, the goal here seems to be improving cash flow for these businesses.
Exactly. It's money they can reinvest, hire more staff, or just, survive. But the permanence part is key.
Why?
When a tax cut is temporary, businesses tend to hoard cash. They're afraid of the rate snapping back. When it's permanent, they feel safer buying equipment or expanding. It removes uncertainty.
And uncertainty is the enemy of growth.
Precisely.
Okay, we have covered a lot of ground. Let's try to put a bow on this. If we're looking at the winners of the 2026 tax season, who are they?
I see 4 clear buckets. 1, the hourly grinders, tipped workers, overtime workers. But, and this is a big, only if you're willing to do the paperwork.
Right.
2, the silver tsunami. Seniors under that income cap get a massive deduction boost. 3, families. They dodged the fiscal cliff and locked in bigger credits. And 4, small business owners in those high-tax states.
It all sounds great, but I can't shake this feeling that the trap here is the paperwork. We touched on it with the overtime stubs. It feels like a broader theme.
That is the big actionable advice for today. You cannot be passive. You have to be proactive, especially with the tips and overtime. You must file Schedule 1A.
If you just let your software autofill from your W-2 and hit submit,
you will lose thousands of dollars. You have to literally interrupt the process and say, wait, I have overtime income to deduct?
you have to advocate for yourself.
No one else is going to do it for you. And honestly, for the overtime part, I'd tell people to start a spreadsheet now for this year. Don't wait until next January to go hunting for pay stubs.
That's great advice. So big picture, what does this all mean for the future of taxes?
It raises a really provocative thought. We're seeing a tax code that offers these huge breaks, but only to people who meticulously track their own data. We're moving away from a system where the employer's W-2 is the final word, and toward one where the burden of proof is on you, the individual.
It's like the gig economy mindset is being applied to all tax compliance. Everyone for their own CFO now.
Exactly. And it makes you wonder, does this signal a future where your tax savings are determined less by how much you make and more by how well you keep your own books?
So if you're disorganized, you pay more.
It's essentially a tax on disorganization.
That is a terrifying thought for someone with my desk organization skills. I guess I better go find those pay stubs from last March.
Good luck with your filing, and don't forget, Schedule 1A.
See you next time.